We're going to start back up again with part 2 here as we talk about the benefits and the negatives associated with leases to the lessee. So as far as disadvantages, it's going to be more expensive to lease an asset than it is to buy it. It's just going to cost you more. From the lessee's vantage point, the advantages and the disadvantages of leasing can result from financing and strategic issues and can include some risk reduction along with some tax issues. So the lessee can have some benefits in relating to leasing assets. But generally with lessees, it's about reporting it financially. From a financial standpoint, a lease provides 100% financing, so the lessee acquires the use of the asset without really having to put down a lot of money up front. The lessor usually charges a higher rate because of the benefit that a lessee is getting from not needing to put down that money up front. From a strategic point of view, lots of companies really don't have the ability to come up with the cash to purchase those items. They don't have that outlay, and so as a result of that, leasing is a better option for them. Starbucks usually leases locations, so that way they don't have these huge capitalization of assets when they choose to be done with a storefront. They usually lease them for 10 years. Leases provide exit options that aren't as costly as when assets or buildings are purchased. So there are definitely some benefits here with having leases versus the purchasing. As it relates to risk reduction, it reduces risk. There's not quite the debt out there. And when you're purchasing an asset, specifically technology, the fact that it can be outdated very quick is a high risk, especially when you put a lot of money into it. Leases usually are structured so if equipment or technological types of assets become obsolete, then they can return it and replace it for more current equipment. So basically that risk isn't there for the lessee. It gets transferred over to the lessor. And from a tax standpoint, being able to deduct that lease as an expense, they get to write off things faster than just depreciating an asset. So the deductible lease payment is depreciated, whereas if you lease land, you can't even depreciate land, and therefore it's not even a deduction at all, since you know land as an asset on the books is never depreciable. Now, as we relate to additional benefits and disadvantages, operating leases do not create an asset, but they also do not create a liability to the balance sheet. There are required disclosures regarding leases, but there are not consequences related to debt on the balance sheet. It doesn't affect ratios as it deals with liquidity and leverage ratios, and so therefore they do not have to worry about their debt to asset ratio or debt to equity ratio. So the ratios, because of the leasing method, are going to be better for leased assets than they're going to be if they would be shown as a purchase. Removing that liability or not having that liability on the balance sheet really creates an impression of the ability to have a greater borrowing capacity. So those are benefits, those are some disadvantages. Let's work through a problem here as we deal with purchasing and leasing. So this slide says in 2013, debt company and lease company have the following identical financial information related to any new acquisitions. They both have current assets, they have non-current assets, they have current liabilities, non-current, and shareholders' equity. So you see the current assets are $2,100,000, non-current $2.9 million, current liabilities at $1 million, non-current liabilities $1.6 and then shareholders' equity at 2.4. So on December 31st, debt purchases equipment with a 10-year life at a cost of $2,825,112. Debt signs a 10-year, 12% note requiring $500,000 to be paid at the end of each year starting on December 31st, 2014. The payments include an interest at 12% of the beginning of year principal balance, and the remainder of each annual payment reduces the principal. Because this transaction is a purchase by the issuance of debt, debt records the asset purchased in the note payable. After the purchase, debt's non-current assets will increase by the amount of the new equipment. Its current liability is going to be increased by that present value of the first of the payments, discounted at 12%, and its non-current liabilities are going to increase by the present value of the last 9 payments, again discounted at that 12%. So the balance sheet for debt is going to show, after this acquisition, non-current assets along with the current liability, that's the present value portion of the first payment, and then the non-current liabilities, the additional 9 payments showing there. Excuse me. Now, by taking on this debt, debt's current ratio falls a lot, and that's going to affect the assessment of the company's liquidity. And debt to shareholder equity ratio doubles. This affects perceptions of long-term creditors or shareholders as to the solvency of the company. So these adverse purchases here, coupled with the purchase with the rate of return on assets, is going to make it difficult for debt to borrow or even to sell stock. At the end of 2013, lease company leases identical equipment, agrees to pay $500,000 rent each year for the next 10 years. If the interest rate's at 12%, then the present value of those payments is going to be $2,825,112. But if Lease classifies the lease as a capital lease, it records an asset and a liability, and the effects on the balance sheet are going to be the same as the effects of the purchase of debt's balance sheet. But if the lease is classified as an operating lease, then lease doesn't have to record the asset or the liability. The current ratio after the lease remains at 2.10 to 1, and the ratio of debt to shareholders' equity is going to remain the 1.08 to 1. So the rate of return on the assets, assuming that that expansion was beneficial, is going to be higher than for debt, even though lease acquires equipment identical to that acquired by debt. So that really helps you see how it plays out on the balance sheet for a purchase versus a lease. Now, how do these benefits and disadvantages affect the lessor? With an operating lease, the asset remains on the lessor's balance sheet. The lessor recognizes rent revenue, and usually that's going to be recognized at the monies that come in. But if the lessor has a capital lease, then the lessor is going to treat that asset as sold. Sorry about that interruption. For getting back to the lessor, when we're dealing with a capital lease, that lessor is going to treat that asset as though it's been sold and records the receivable, and basically the financial statements are going to be affected for the lessor in this scenario. From the lessor's point of view, the advantages and disadvantages of leasing an asset relative to selling it relate to providing a method of really making a sale while still maintaining some of the advantages of ownership. And leasing is basically an opportunity for a profit, and it enables the lessor to transfer an asset by the lease agreement, but permits the lessor to still get a rate of return based on interest on selling the leased asset. Now, the negative with the lessor is the risk. It's 100% financing. So that's a big risk for the lessor in leasing that asset. Now, let's look at some terms we need to become familiar with. This bargain purchase option, that is one of those criteria for a capital lease, a contract provision allowing the leasee to purchase the leased asset at the end of the life of the lease at a price so favorable that the exercise of the option appears at the inception of the lease to be reasonably assured. So it's going to happen. The bargain renewal options, that provision in a contract that allows the leasee to renew the lease for a rental that is so favorable the exercise of the option appears to be pretty assured. Now, the estimated economic life of that leased asset is the estimated remaining period during which that asset's expected to be usable for the purposes that asset was placed into service for or was intended for. The estimated residual value is basically that fair value of that asset at the end of the term. And then the executory costs, such as insurance and property taxes and maintenance, are those that can be paid by either the lessor or leasee. Now, usually it's expected those costs are going to be borne by the party who controls that asset technically as its owner. Some more terms: the fair value of a leased asset, the price that's going to be received to sell the asset in an arm's length transaction between a willing buyer and a willing seller. If the lessor is going to be a manufacturer or dealer, then that fair value of the asset at the inception of the lease is usually the selling price. But if the lessor isn't the manufacturer, the fair value is going to be a cost of the asset to the lessor. Now, what is a guaranteed residual value? That's going to be the portion of the estimated residual value of the leased asset that's guaranteed by the leasee, unrelated to the lessor. And the inception of the lease is really the date of the lease agreement, or based on an asset being constructed, the date that that title passes to the lessor. Initial direct costs are those incurred by the lessor to set up a lease. These can include activities like evaluating the leasee's financial condition, preparing the documents, closing the transaction. And then the interest rate implicit in the lease is that discount rate that, based on the present value sum and any of the unguaranteed residual values, basically results in a value to be equal to the fair value of those leased assets. So those are definitely some terms that you need to be familiar with in a matching. Lease receivable is basically the gross investment in the lease. And the term is going to be that non-cancelable term of the lease, along with any periods based on a bargain renewal option or a renew lease. So it's going to be the entire amount of time plus any renewals. In no case does it extend beyond the date a bargain purchase option then becomes exercisable. Now, the incremental borrowing rate is based on that rate that the lessee would have incurred to borrow over a similar term the cash necessary to have purchased that asset. And then when we're dealing with manufacturer's profits or losses, it's that profit or loss, the difference between the fair value of the asset at the inception of the lease and that cost or carrying amount of that leased asset. And then our minimum lease payments are those payments that are going to be required to be paid by that lessee to the lessor over the life. So basically, if it contains a bargain purchase, then it's going to be the minimum lease payment and also includes that bargain purchase option price too. And then the non-cancelable lease term is going to be the portion of the term that's cancelable by the occurrence of some remote contingency or permission of the lessor, or if the lessee enters into a new lease by that same lessor, or the lessee incurs a penalty of that at the continuation of the lease appears at inception reasonably assured. Then finally, our unguaranteed residual value, that estimated value of the leased asset that's not guaranteed by the leasee or by a third party unrelated to that leasor. So you can see here an operating lease agreement contract where it states the parties, it states the lease term, that it is non-cancelable, and the payment amount. And it also identifies the equipment and what the fair value of that equipment is and the economic life, and that there's no guarantee of a residual value, and how the equipment will revert to Starling at the end of the 5 years. It contains no bargain purchase and no agreement to transfer ownership at the end of the lease. It lets us know the incremental borrowing rate and the interest rate implicit in the lease, and then lets us know the present value of the annuity due in 5 payments. So this is the present value of all the lease payments. So as we look here, to be able to determine if this is a capital lease or an operating lease, the ownership isn't going to be transferred at the end of the period. It doesn't include a bargain purchase. The lease term isn't 75% or more of its economic life. It's only 5 years. And the present value of all those minimum lease payments is only 67% of the fair value of the asset. So this, in this case, would be an operating lease. For it to be a capital lease, it would need to meet one of these capitalization criteria. And as we can tell, it doesn't right now. So the journal entries that will be recorded would be showing a debit of prepaid rent and a credit of cash. And then at the end of the period, we would debit our rent expense and credit our prepaid rent. Now, if they would prepare quarterly statements, it would take that prepaid rent and credit it and put it to the rent expense every quarter. They generally are set where they're structured that the lessee is going to pay a rental payment plus sometimes an additional amount based on usage or some type of consumer price index charge. These contingent rental payments are basically contingent because of a potential future event occurring. Now, if those contingent payments are included in the lease agreement, then the rental payments need to be expensed when it's likely the contingency is going to be met. Now, I'm going to push to the next section to talk about capital leases.